Hello and welcome to a mini trading tutorial from OptionsA2Z.com, the website dedicated to teaching investors the art and science of options trading. In this video, we are going to introduce you to options, what they are, how they work, and why they are becoming so important for investors in today's market. Let's start with a definition. An option is simply a contractual agreement that has three key characteristics. First, they give you the right to buy or sell shares of stock. Second, at a fixed or a predetermined price. And third, over a given time period. There are two types of options. You have call options and put options. For call options, the owner has the right, not the obligation, to buy shares of stock at a fixed price over a given period of time. For put options, the owner has the right, not the obligation, to sell shares of stock at a fixed price over a given period of time. While this may sound complicated, you've already used things very similar to calls and puts. For example, a call option is very similar to a pizza coupon. If you are the holder of this coupon, you have the right to buy a pizza. Also, you cannot buy all the pizza you want. There will be a limited number specified on the coupon. In this example, it is good for one large pizza. However, if you choose to buy the pizza, your purchase price is locked in at a specified amount, in this case for $10, no matter what the price of pizzas may be when you get to the store. Finally, there is an expiration date. There's only so long that you're allowed to use this coupon. Likewise, if you buy a Microsoft $20 call, for example, you have the right, not the obligation, to buy a specified number of shares of Microsoft. In most cases, each option contract will be good for 100 shares. If you choose to buy the shares, your purchase price is fixed at $20 per share, no matter what the price of Microsoft may be in the open market. And finally, you could only use that contract through the expiration date in May, which is usually the third Friday of the expiration month. We just found that call options are similar to pizza coupons. What about puts? Well, put options are very similar to an auto insurance policy. If you buy an auto insurance policy, you have the right, not the obligation, to sell your car back to the insurance company if you should wreck it. Likewise, there is only a limited number of time that you can use the policy. There is an expiration date. Likewise, if you buy a Microsoft $20 put option, you have the right, not the obligation, to sell 100 shares of Microsoft. If you choose to sell the shares, your selling price is fixed at $20 per share, no matter how low of a price Microsoft may be trading in the open market. And finally, you could only use that contract through the expiration date in May, which again is usually the third Friday of the expiration month. Remember, option buyers have rights, and that's where these assets get their name. In other words, it's your choice or option to choose whether or not to use the contract. We just found out that option buyers have rights. Well, for every buyer, there must be a seller. What happens if you sell an option? Option sellers have obligations. If you sell an option contract, you receive cash today, but in exchange, you accept some type of obligation. Option sellers are simply accepting cash today in exchange for nothing more than an agreement to accept an obligation. Well, what are the obligations? The seller's obligations are easy to understand once you understand the rights of the buyer. For example, if you buy a call option, you now know that you have the right to buy shares of stock. Well, as the seller, you're on the opposite side of the transaction, so you would have the obligation to sell. Notice that the opposite of a right is an obligation, and the opposite of buy is to sell. So you can always figure out the obligations to the seller by just understanding the rights to the buyer and flipping it over. What about for a put option? You now know that the put buyer has the right to sell shares, and therefore the put seller must have the obligation to buy shares. It's important to understand that when we are talking about option sellers having obligations, we really mean the short sellers. Short sellers are those who enter the contract by selling it. They sell contracts they do not own. So just because you sell an option does not necessarily mean that you have an obligation. It's only when you are the short position. For instance, if you start out by purchasing a Microsoft call option and then turn around at a later date and sell that same contract, you have no contracts in your account, or what we call a flat position. It's no different than if you purchased 100 shares of Microsoft and then sold 100 shares. You have no shares. However, if you start out by selling the contract, then you receive cash today in exchange for accepting an obligation. So if you initiate a position by selling it, then that is a true short position and you have some type of obligation. While these rights and obligations create fascinating opportunities, how can you be sure that the transactions will go through? Is there a risk of default? It is the Options Clearing Corporation, or the OCC, that ensures contract performance. The OCC is a highly capitalized and regulated clearing firm. In fact, ever since 1973, when the OCC was first established, not a single investor has ever faced default risk. How is that possible? Well, the answer is that if you buy an option contract, you're really buying it from the OCC. And if you sell an option contract, you're selling it to the OCC. The OCC acts as the buyer to every seller and the seller to every buyer. The OCC ensures that all obligations will be carried out if you decide to buy or sell your shares with your contracts. Once you understand the rights and obligations that options convey, you can create risk profiles that cannot be created with stock alone. For example, here is the risk profile for long shares of stock purchased at 50. And what we're looking at here is the stock price along the horizontal axis and profit and loss on the vertical. If you buy shares of stock for 50 and let's say it rises to 51, we just trace a line, in this case up to the curve and over to the left, and it shows that you will make $1 profit. On the other hand, if the stock falls to 49, we find 49 and trace a line down to our profit and loss curve, and we look to the left and it shows that you will lose $1. And if the stock price remains at exactly 50, you'll just break even, no profit or loss. So what this shows is that when you buy shares of stock, you always make dollar for dollar if it rises, but you're also at risk dollar for dollar if it falls. However, if you buy a call option instead, your risk profile changes from the straight red line to look more like this hockey stick shaped green line. You can see that the option eliminates the majority of this downside risk and in exchange requires you to give up a little bit of your upside profit. However, you still can profit in an unlimited fashion just as the long stock position, but with less risk. Option strategies are simply trade-offs in risk and reward. Your long call risk profile can be changed from the center graph here to any of these others and more. With a simple purchase or sale of a call or a put, you can change into any of these other fascinating profiles. This allows you to change your risk profiles as markets change. Okay, let's review the main points. Call buyers have the right to buy shares. Put buyers have the right to sell shares. Call sellers, on the other hand, have the potential obligation to sell their shares. It's a potential obligation because you can never be sure if the long position or the buyer is going to use their contract. Put sellers have the potential obligation to buy shares. Options allow you to create unique risk profiles. And finally, it is the OCC that guarantees all contract performance. If you are interested in advanced knowledge on options, please visit www.optionsatoz.com and consider the 9-week Alpha Trader Certificate course. It's a great start to understanding the options markets, mechanics, pricing principles, risk profiles, and I'll even include 3 powerful strategies. I hope you've enjoyed the video and now understand the basic mechanics of calls and puts, and with a little work you can become a better investor by using options to structure risk-reward profiles that are better suited for your needs.